Hey guys, thank you all for joining and welcome to the West Side Real Estate Meetup hosted by WNA Properties. So it's 6:35. We're starting a little bit late and we did change our time for this week. So yeah, I hope more people are joining it. We're about to start the meeting. And before we start, we've already hit the recording. So if you don't want to it will be posted on social media. So if you don't want to be on that, you can go ahead and turn off the camera. Yeah. So my name is Young and I'll be the moderator for tonight's meetup. And to briefly introduce myself, I'm a buy and hold investor using the BRRRR strategy from out of state. I'm a working professional striving to achieve financial freedom through real estate investing. And I've recently completed my second BRRRR and I just closed on the third property yesterday. So if you have any questions for me, please feel free to reach out after the meetup. And before we begin, we will have everyone on mute except for the presenter to minimize any distractions for both the presenter and the audience. And please feel free to ask any questions in the chat box below throughout the presentation. And this one will be our last meetup for the year. So tonight we're going out with a bang. Our speaker tonight is none other than CJ Calio, and he'll be sharing his thoughts on the market and how we can prepare for the potential shift. CJ and his wife, Jasmine, are both buy and hold out-of-state investors. They're proud owners of the WNN Properties, which is a mentorship and consulting company that works with busy professionals to create passive income through real estate so that they can live the lives they were meant to live rather than living paycheck to paycheck. WNN Properties has raised over $8 million to purchase over 80 residential and commercial properties in the past 5 years. CJ is also a licensed real estate agent and has over 5 years of trained experience in marketing and sales. CJ and Jasmine have recently been able to quit their day jobs and live the dream of being full-time investors while spending more time with their 3 beautiful children. Again, please ask away any questions you guys have in the chat box throughout the presentation. And now let's welcome CJ.
Thank you, Young, for the wonderful introduction, as always. I appreciate it. Welcome, everybody, to the meetup. As usual, it's an honor to always speak in front of you guys. So today, being at this topic, it's coming from a perspective primarily my own. I'd like to make a quick disclaimer. I'm not a financial advisor or a legal counsel. All information given tonight is from my perspective and my opinion, and possibly from my past history. So I encourage you to do your own due diligence with any information that's shared tonight, and verify it with your respectable counsel. Okay, so we'll start off with current market. So I'm probably going to tap on 3 things today, but the current market is the beginning of our topic, right? 2020 has been one heck of a ride so far. It's not over yet. And obviously, a lot of people didn't foresee, or I don't think anybody saw, COVID being the reason why the market is what it is today. And what I mean by that is that 2020 has its pros and cons, right? When COVID hit around February or March and it became a reality that the new norm is now this weird, ever-evolving organism, we had to adjust, especially in the real estate world. It affected us greatly in good and bad ways. So I'd like to discuss some of the pros and cons that I saw recapping so far up until current date of 2020. So let's start off with the cons. I like to get those out of the way right away. The cons is that COVID changed the rules, right? The rules changed drastically, and it's almost overnight to an extent in the initial release of COVID and all that information that shutdowns were happening, mandates were being in place, things were changing where you're not essential or you're essential as an employee, which now affects, a lot of people's financial situation, right? And being that finances is tied to real estate, it was inevitable that it affect everybody. So some of the financial hardships led to people not being able to pay their mortgages, asking for forbearances. And if you're like me, a buy and hold investor, sometimes when your tenants lose their job in this type of situation, they're unable to make rental payments, right? And on top of that, the memorandum from the CDC and some of the federal regulations prohibits us from evicting them if they can produce evidence that it's COVID related. right? And they also put a freeze on rental income. You can't raise rents even though it's potentially time for the lease to be renewed. So all these things have provided us some obstacles and challenges and opportunity for us to grow. Now, there were some pros that also came in 2020, if you choose to see it that way. And what I chose to see as pros were some of the assistance programs that came out, right? Stimulus money for those who were affected by the shutdowns, if they're furloughed from work or laid off due to not being essential, whatever that means. The ability to tap into your retirement accounts in some way, shape, or form with minimum to no penalty payments or forgiveness of some sort. The PPP loans, right, for businesses that were able to utilize and tap into to then assist themselves with making it through this challenging time. And if you haven't noticed, at least in Hawaii, interest rates are extremely low, and it's a really hot seller's market right now. I mean, watching properties come and go off market in a matter of days with bidding wars and over ask offers, it's insane. So whether you choose to see it as a pro or con, these things are things that actually happen. And it's good to have that as tangible data for you to then prepare for what's to come, right? So now we understand that COVID brought some challenges and some blessings. Let's now go into how to prepare. So everybody, it's a big question I get asked often. What are you preparing for next year, especially towards the end of the year? I get asked this every year. And if you've known me or have talked to me within the last 5 years, my answer is always the same. Prepare for the worst, expect the best. It's always been our strategy. It's always something we've planned for. We want to and prepare to be able to sustain during a situation like this COVID, right? Now, COVID tested our philosophy on this because we're advocates of putting away for rainy day. Well, rainy day for COVID, if you were to keep track of when the shutdown and the non-evictions went to current day, it's well over 6 months. It's pretty standard to hear that conservative investors like to put away 6 months of rainy day. Even some financial personal advisors advise having 6 days of rainy day, 6 months of rainy day funds. Well, this COVID really tested our resolve to commit and stay true to what we believe in. Well, again, 2021 is around the corner. As much as I'd love to read into the future and know what's to come, I don't. And frankly, I don't care. Because every year for the last 5 years, going on 6 years now, entering into the new year, it doesn't matter what the market does for me. And why I say that is I'm prepared for the worst case scenario. And even more so now with COVID, I know I may have to extend or add to my emergency situation. And once I have that foundation, that sustainability, knowing that when the worst happens, I will be okay, especially not being able to simply just go back and go back to my 9 to 5, which I vowed never to do again. I have to ensure that our livelihood will be fine. Once I was able to sustain, and when I plan to sustain and prepare to sustain, it puts me in a position of power, of control, the ability to capitalize on opportunity when it presents itself. This is why I say it doesn't matter what comes in 2021, whether it's a shift down, stays the same, or continues to rise. I know I'll be okay if it goes down. And if it sustains and rises, I plan and attack accordingly, right? So I change my strategy as the market dictates it because I'm following past data. So what I like to do is look for investments that are sustainable, right? Which is why I've been and always will be a buy and hold investor. I can sustain through just holding for a long period of time. And real estate is a great asset. It cannot be physically taken from you. You can't lose it. And it's always going to retain some sort of value. Yes, you can argue you can lose it in a lawsuit and so forth, but that's a whole nother wormhole to go down. So that's preparing for the downturn or whatever shift is to come. And in all honesty, you have the ability to prepare for anything as long as you know why you're doing something, what you're doing, and how you're going to achieve success. I'd like to end with the mindset part, because to me, everything begins and ends in your mind, right? So if you're coming from a space of fear, unknown, hesitation, that's emotion. That's emotion driven, which tends to bring it from a irrational, unlogical state of mind. Versus if you come from a space of like abundance and opportunity mindset, you are able to take a hold of and capture deals, opportunity, timing, no matter what the market is. And another part about taking action that I like is it puts you in the power seat. Taking action gives you the control versus being a person that reacts. So if we were to revisit what COVID did, if people are reacting because of COVID, it's a little late for that, right? As opposed to being active upfront or prepared, you can control your destiny a lot more clearly, right? So action brings control, action brings power, action brings confidence. It keeps you in that space where if you take enough of it, you will be successful. And it doesn't matter what the market is, because you will see and find opportunity in all markets. That's really my short presentation. I personally like engagements. I want questions. Now's the time.
Hey CJ, thank you for that. I actually want to just add on to, you know, the rules. I feel like this COVID and, you know, having tenants not paying bills or rents anymore, I feel like, you know, this is kind of maybe making us to fine tune, like having a stricter criteria with the tenants screening, and also maybe avoiding in the lower class of neighborhoods, because those are the probably less stable tenants, you know, who are more likely to not pay or unable to pay. So like, I guess personally for me, I've been okay so far, knock on wood. So yeah, I think this just kind of reassures at least the area that I'm focusing in, maybe like B2C neighborhoods, or just kind of continue in that realm. And even if, you know, something like this that no one's ever, you know, really foreseen happens, then, you know, we can still be all right.
Yeah, I'd like to add to that. Neighborhood class, type of tenant quality, property selection, those are all strategies, right? And formulating a successful plan will be key for your success, because personally, I'm in all demographics. Lower income, if you want to call it that, middle class, high, and commercial. All of them can perform well, but each of them takes a specific strategy to ensure success, right? So if you're coming from a space where I only can invest in the CB neighborhoods, well, that's fine, but you're also limiting your opportunity, right? If opportunity presents itself in a higher class, a lower class, or anything in between, plan accordingly, right? Run through the scenarios of worst case. So if you feel maybe a lower grade tenant quality or rental class will bring more risk, adjust, pivot your numbers, right? You can still calculate it out to be successful if you know how to run your numbers. And the only way to run your numbers is to have tangible results, which requires you to take action. If you're not taking action, I mean, you got a lot of information, but it's only good if you apply it, right? Knowledge is quote unquote powerful, but to me, knowledge is truly powerful when you apply it, applied knowledge.
Good stuff. Thank you.
I got a question, CJ.
Yes.
You mentioned 401k, and I guess the rules have been changing a little bit because of COVID. So in your opinion, should somebody take a withdrawal from their 401k to invest in real estate?
Good question. And being that I'm not a tax or legal advisor, that would be something you want to seek from your personal guidance. Personally, we have, and we choose to. It's a great time if you can see opportunity, right? Some people are taking COVID as, oh, opportunity is all frozen. We can't do anything. That's not true. It's a matter of, can you see it? Are you creating the knowledge or educating yourself, informing yourself of what opportunity might be presenting yourself next? Because like COVID, how that came out of left field, well, who's to say that there's not an offsetting positive opportunity that can come from real estate? Like an example is some of the Airbnb people I know, they're hurting and they're struggling, especially in Hawaii right now, because there's so much restriction and regulations and the inability for incoming tourists or travel. They're greatly affected. So instead of just calling shop and being foreclosed, some are actually selling, taking advantage of the seller's market and finding out that they can now move their money to somewhere else. It's the same thing with like retirement account, in my opinion. If you don't like what the stocks or whoever's managing your account is, and you feel like you can do better in real estate, the only way to truly find out if you can is apply it and do it. So personally, we've done it. Why? Because we love real estate. We know we can make better returns and we have the control.
Mm-hmm. Right. And like you said, take action, right? You're not going to know until you actually get out and find out, right? So
Right. There's a lot of free information out there. You can read all the books you want, join all the podcasts, join all these meetups. Inevitably, the only way for you to truly believe in any of this is to set up a plan, take that course of action, and find out through the results.
Cool. So, going back to taking action, and if I was somebody new, like I want to get into real estate, but because of COVID and everything that's going on, I guess, what should I consider, like as a new person, what should I consider as I jump into real estate investing?
So consider meaning where to start?
Like where to start, because, people are saying that it's the best time to invest because of COVID, and people are also saying it's the worst time to invest because of COVID.
Right.
So as a new person, what kind of things can I look for to help me decide?
I don't remember which that advisor was, but it says trust but verify. And how I take that with what your statement is be careful who you're listening to, right? So get the information, verify it, and do your homework. At the end of the day, you got to figure out a strategy. So the why is extremely important. If you can formulate why you want to begin investing, you tend to line up the inevitable action steps you need to take to get to the how. A lot of people like to start with how. That's great, but it's very general because you tend to be more of that reactive side. So you're not in control of why. You're hoping the why will formulate by doing the how. I see it reverse. You want to start with the why, then the why will lead you to the what, which then will equal the how, if that makes any sense.
Yeah,
that's kind of our formula we started with, is we figured out why real estate. And then from there, we figured out what part of real estate we wanted to do. And then the how led to the action, right? How to invest in out of state, how to get cash flow. It was a lot smoother transaction versus starting with the how. The how is how to flip a house, but do you really want to? I don't know. Does it reach your objective or goal? And it gets murky. And I see people spinning their wheels way too often because they don't know why they're doing something, but they know how,
Okay. So getting a clear picture of why real estate, start off with that, and then kind of, okay.
So going to your point of listening to people who are advising you to start here or do this, those are great starting points to help formulate why you're going to get into investing, because something's got to click, right? But then you also have to verify what they're saying is an actual process. Some scams start off that way, yeah? They get you all hyped up for a product or an opportunity, and you get emotional. And again, emotions, when they're high, your intelligence tends to be low. So be smart about it, verify it, take your time, plan it out, prepare for success, anticipate success. But it all starts with you understanding and formulating why you're doing whatever you're doing.
Can I ask, like, how long did you guys kind of think about your why or plan all that out before you guys actually took action?
If I recall, our first, we do visions yearly. and it's something we live by and think it's extremely important to implement in not only our investing but in our life in general. It helps us give clear guidance and structure and tangible goals to measure our results, right? So I believe our first vision was 6 years ago, and we're finishing our last vision for this year, which is year 6 completed. And when I revisit my first vision to current day vision, just the sheer contrast between my mindset of how I started to present day, I wouldn't have thought that was me. I wouldn't have thought where I'm at today 6 years ago is where I'll be starting my new vision for 2021. And what I mean by that is don't be afraid to start where you're at. Create your vision so you can formulate the why, then the what will appear, and then also the how. Take the time, use the vision. Your vision is a great tool to bring clarity, because you got to know what you want before you start what you're doing, or else you're just following what people are suggesting.
Yeah, that's true. Wow, thank you for that.
Hey CJ, I got a question for you.
Yeah, Michael.
Hey, so first of all, this is my first meeting, so I'm Michael Duncan. For anybody who doesn't know me, I've been in Hawaii for about 8 or 9 years now, active duty Navy, and been doing some buy and hold rentals out here, and also in the States a little bit. But I just kind of wanted to ask you a strategy question, because you mentioned the market is so good right now. Are you guys implementing any more flips into your portfolios, given like how good the market is and top dollar people are paying, or are you sticking to your buy and hold strategy, or are you using any other ways to capitalize on the market to kind of infuse some other cash, I guess is my question.
Got it. For clarity, we've never really flipped. And if it was a flip, it was unintentional. It's just a byproduct of we couldn't pass up the offer. Every deal we look at is in an out-of-state cash flowing market. And we buy specifically for cash flow. So regardless of the quote unquote rehabs I do on Facebook that people might be seeing, it's all for me to retain. And I don't, the strategy I like to implement is the BRRRR. And if you understand the BRRRR strategy, if you do it well, you can rinse and repeat the same amount of money over and over again, as long as you can get mortgages out. And by doing that, it allows me that equity play, that quote unquote capital you might need if you were to just buy, say, a turnkey product, right? So I have endless opportunity in that sense if I'm able to get a well-oiled BRRRR machine going. And everything I do is, again, out of state, just because, like Hawaii, I mean, I'm sure you know it, your buy-in is so high here to get such a little to probably negative return on investment for cash, you're playing the appreciation play. So yeah, I hope that answered your question. And if it didn't, please let me know.
Yeah, definitely answered it. Appreciate that. Thanks.
Yep.
Yeah, I kind of want to chime in on that, because I feel like with COVID, there was so much scare, but at the same time, the interest rate dropped so low that if let's say you're just not able to recoup all your money after your BRRRR, however, you have like this awesome mortgage rate. It's a lot lower than before, so I feel like I'm cash flowing more now than pre-COVID, honestly. When I refinanced it, I just had better terms. I feel like there are pros and cons. One goes up, the other one goes down, and as long as you're just analyzing correctly, I feel like you can stick with that strategy.
Yeah, I agree with you. And that's why, like, whether you're a buy and hold or a flipper, if you go back to the sustainability, it comes down to the numbers. At the end of the day, it's all about the numbers, right? So if the market is going up, but you're only running your numbers as the market goes up with no consideration to a potential turn, well, you're putting yourself in a dangerous position where you might end up one of those cons who can't make their hard money payment, can't offload for a profit. You're going to take a loss, versus someone who is actively flipping, who's anticipating some sort of shift as their worst case scenario number, knowing that they will still either be profitable or at least break even, then it makes sense, right? So understanding that formula of prepare for the worst, no matter what type of investing you're doing, I think that would be extremely beneficial, because then it sets you up for success no matter what. Because worst case scenario, you're hitting that floor. And that floor should always be something of a break even, or if not, slight profit, right? I don't ever want to lose money. What is Warren Buffett's rule? Rule number one, don't lose money. Rule number two, refer to rule number one. I don't want to lose money. I want to make sure I plan and prepare accordingly. That way, it doesn't matter what the market's doing. My results will be within this margin or this range, and I'm okay with any of that range, because that's what real estate investing is, right? We work within margins and ranges.
So how has your analyzing been going now? Are you running numbers more conservatively, or are they the same? Or yeah.
Good question. It'd be a lie if I'd say it's the same. I do want to say that I do come from a conservative space still, even more so now with COVID. But everything, I pivot, right? So if the market is playing this, I go opposite. And some of the offsetting factors to the positive side of COVID is I've seen an influx of higher end offers and purchases on property that aren't valued at in my market, which makes me not competitive. So my strategy right now is to be patient and to be smart about what I'm acquiring, right? Back to that strategy of sustainability. I buy sustainable assets. So if it doesn't sustain or break even or cash flow in some way, shape, or form, I'm not looking at it. I'll just wait. I'll pass on 100 deals if I have to, because I am preparing for when the market shifts. I'll have liquidity. I'll have the abundance of capital to then scoop up everything. And Warren Buffett, what he says, when it rains, you don't go out with a thimble, you go out with a big bucket, right? I want to catch all the opportunity I can and be prepared for it. So right now in my market, I'm extremely picky, to the point where some of my team members are frustrated, but they understand, right? They're torn because they know we can't compete. I can't compete with somebody who's willing to pay over ass for a property that needs rehab work. It's not mortgageable. I can't compete with that, versus being disciplined and patient and knowing that in time, my patience will pay off. Because instead of getting one now by chasing, if I wait, maybe in a few months, I'll get 10 for the same price as one. Who knows, right? Look at what happened in 08. You bought in 07, in 08, you regretted you didn't wait till 09.
Thank you.
Yeah, you're welcome.
So, about analyzing, has the election also affected the way you analyze things? Or have you seen a change in your market now that we're past the election?
Not yet. Again, I said, I'm preparing for a shift. And personally, I think come second quarter of next year, if I'm preparing and forecasting personally for myself, opportunity will be more available then, or it's going to be delayed even more. It all comes down to those who are controlling the regulations and the rules, right? I'm just a little fish in a big pond, and I have to abide by that. But it doesn't mean I'm going to miss out on opportunity along the way. I just need to be smart about what I'm biting off. So yeah, I think it's going to do something. What that something is, I frankly don't know and really don't care. I'm just preparing for whatever can come, whatever ends up happening, with the whole presidency stuff.
Yeah, or when things are going to happen. Yeah, you never know. I think people have been predicting that we're going to have some kind of a bubble starting 2015 or something way back, but it's just been climbing up and up and up and up.
Right.
Yeah, and when COVID first started, I was so scared because I had a property under contract and then COVID happened or something like that. So I was so scared. I almost walked away from it, but that was my second burr and it ended up being a great deal. I got great interest rate I got all my money out. It's renting actually higher than my first property. So yeah, I think you just have to, just keep steadily taking, whatever is available that has the best opportunity for you. If the numbers work out, still get it. But it definitely was, it's been very, very difficult to find properties. That's for sure.
Well, if we're going to talk about that property, let's go into a little bit more detail, Young. When you analyzed it, you prepared for the worst. Am I wrong?
For the second property?
Yeah. You prepared for the worst. You prepared. And you understood the potential results of the worst case. Did it stop you?
Almost, but I was talked out of it.
Did it stop you?
No, it didn't.
Didn't.
Yeah.
And aren't you glad you stuck to your guns and took action, right? I mean, you basically lived out what I was talking about. Yeah. You prepare for the worst and you take massive action. You can't control a lot of what is out there. You can control whatever's in your little wheelhouse, your realm. So be great at controlling that, but be okay with what other external factors dictate your results to be. Because I think we discussed this the other day, but it's not really the results we're after, it's who we're becoming. Am I becoming a better investor? Am I becoming a better analyzer of deals? Am I doing more research and knowledge seeking? Am I applying what I'm learning and seeking out knowledge from? Am I networking? Am I growing my teams? These are all crucial things, right? I mean, you're becoming a successful habit creator. Your success is greatly in part to your daily habits or the habits you're forming. So I'd argue you lived out what we just talked about.
Yep. About to do another one, so we'll see. I definitely learned a lot from the second property. And this one, it's still a lot of things are like uncharted territory where I have to get permitting. I have to, hire an architect to redraw the floor plans, and, it's going to be definitely something new, and it was scary, but, I'm still going for it. Because I did prepare for the worst, and, if the numbers work out that way, still, I'm not losing money more than I would have paid for a turnkey. But if it does work out, hey, that's, another success, and move on.
Control what you can control.
Yeah.
Cool. Any other questions?
I do have one. Loaning institutions, for the first strategy, second to the last part is the refi part. Do you see a shift in what the institutions do in giving out the refis on the homes?
Got it. So let me just reiterate your question. You're asking on the refinance side of the BRRRR strategy. Do you see that do I see if there's shifts happening in the institutions like the lenders, the banks, correct?
Correct. That's correct.
Yeah. Well, in my personal experience and what we're dealing with right now, yes, there's a massive shift. And what I mean by shift is the rates are extremely favorable for anybody looking to do a refi or even a straight out purchase with a mortgage. I mean, I haven't seen rates this low for an investor mortgage since I've started investing, which I know it's only 5 or 6 years now, but it's really at an all-time low. Secondly, though, what I do see is the length of time it takes to do a refi is no longer this like 45-day window, almost identical to a standard purchase and close. If anything, you're at 60 to 90. And what I've got from my network that I deal with a lot with these lenders, they are claiming that home purchases or outright purchases with mortgages take precedence over refis, cash out refis. So if they're doing a home purchase mortgage up front and they're writing that versus your refi at the exact same time, your refi gets pushed on the back burner. Now the home purchase person gets first precedence. You get back seat. So if they get time, they will then underwrite, appraise and do all this process to get it refinanced out. I've personally seen and worked with people who are about 90 days in and they're still not closed on their refi from the BRRRR strategy. And it's largely in part to the mass influx to the banks, right? I mean, if you think about it, there was a season when PPP loans and all these incentives that they utilize the banks from, people were applying left and right, where banks pretty much stopped lending for any sort of massive purchase unless you're already in the process, because they were just overwhelmed with the volume of work that they had to do. That's what I see with the institutions, at least in what we do. It takes a lot longer than it used to. On top of that, their requirements on verifying income has, I don't know, Jazz, like 4 or 5 times what it used to be. I believe it used to be initial verification for pre-approval, and then something like you produce your recent last 2 pay stubs about 30 days or 14 days out from close and you're good. The last person I spoke with that's still not closed yet, supposed to have signed and closed today on their 90+ day refi, they've done employment verification 6 times in the 90 days. And they had to bring proof today at signing that they're still employed and still collecting checks from work. That's how strict that aspect of lending has gotten in the refinance phase. Now, this is just within my little wheelhouse. I can't speak for across the nation or in Hawaii, but in what I do and with my network, that's the kind of adjustments we need to make when we're doing the refinance and the BRRRR, is anticipating longer holds. Which, if we were to go back to my original prepare for the worst, we just pivot by adjusting our hold time. We expect to hold it for a longer period of time. And if anybody's listened to me, although a BRRRR takes 181 days to officially refinance out from purchase, I always run my numbers at a year, 365. So with this whole COVID delay in the refi side, if you run it the way I run it, you're still fine. 9 months in, 10 months in, you're still fine and dandy. And that's what you've been accounting for. You got a couple months to spare. Again, prepare for the worst, expect the best. So yeah, there is shifts happening, Gilbert. And when you get to a refi phase, if you're implementing the BRRRR, I highly encourage that you ask a lot of questions from the lender and get some clarity up front, because they're not always as transparent as they should be with expectations. So that way you know up front what you're expecting, and then take that and prepare for a worst case scenario.
Thank you.
You're welcome.
Hey, CJ, for that specific person, were they going with a big bank or a small local banks?
National bank. And I got it from the VP himself, from his mouth, that we're just so busy that refinances are very low on our list of things to do. And although it's the bank's fault in delaying the close, the client is the one that suffers, because they got to keep producing evidence that they're employed, keep sending in documents, keep pulling credit, and all this weird things that are frustrating, right? It can be frustrating if you weren't prepared for it. But if you prepare for it, it's just part of the process, and you got to go through with it. Again, you control what you can control. So prepare up front.
Nice. At least for me, I went with a small bank this time. Mm-hmm. And in my opinion, it went through pretty fast. Maybe that's how I felt, because my first property took forever to refi. Right. So yeah, I started, about a month before my 6-month mark, 180-day mark. And then, just having good conversation with them, just being able to provide everything. I think all in all, I think it took less than 60 days for this one, the one I just refied like last week, actually. So yeah, I think smaller banks might be a little bit faster.
And you brought up a good point, right? So just because you need to be 181 outside of refinance to do the new appraised value doesn't mean you, like you said, you could start the loan process sooner. That could be preparation for a more successful outcome versus just waiting the 181 and then beginning the refi process. I think that goes back to my active versus reactive, right? You want to be actively involved in the refinance process. See when it's the earliest you can actually submit an app, knowing it's going to take 45 to 60 days for you to refi. Versus I'm 181, now I'm going to actively look, well, it's too late. Now you're reactive because you're going to have to go with what the bank says. Oh, I didn't plan for 90 days. If you were upfront and talking to them maybe 30 days prior to 181, you might have had a 30-day head start, or at least better prepared to be ready for the extended time.
Yeah, for sure.
I saw Katie's question in the chat. So she put, from your experience, are the lenders requiring more reserves than pre-COVID for refinances or purchases? That's a good question. So far, off of what I've gathered from my lender pool, they're not. They may take into account the appraised value and then the amount of equity needed to be left in. If anything, that's what I've seen a little bit more of. So pre-COVID, if you're under 4 mortgages and you're very well qualified and approved for these refinances, you could sometimes on a single family home get 20% equity left in, 80% LTV. So pulled out, right? 80% pulled out. Now, on some single family homes, depending on your mortgageability, all this DTI and stuff that it's a lot of verbiage and over my head, you may be required to leave in 25 to even 30%, as opposed to before was as low as 20, on an investment mortgage cash out refi. But these are all good questions to bring up to a lender if you're looking to do some sort of purchase or refi. I hope that answers your question, Katie. Oh, there, got it.
What about on the private lender side? Have you experienced private lenders maybe dropping off because of COVID? Has it become more challenging to raise money?
That's an interesting question. I think it's a loaded question. I think it comes down to your skill set and the ability to raise money, right? It's funny because, COVID brings us a level of scare to certain people, but it also brings a level of confidence for others. So who is your network or your pool of private money lenders, and how are you approaching them, right? I personally like to believe if I'm promoting a very valid, solid opportunity, money will come. And it's not dictated by the market or COVID, it's the product and me, right? Essentially, what I think private money lenders buy into is the person they're lending to. The product helps, but ultimately they're putting their trust in you that you're going to perform for a return on their initial investment, right? I've seen some people walk away. I've actually seen more come to, if that makes sense, because they're understanding parts of their investment or their portfolio or retirement are in things that are very uncertain, or let's just say out of their control, and they want to grab and get back a little bit more control. So they're now learning and looking into something like private money lending, and it's a good, safe, soft way to get your toes wet in real estate if you really think about it, right? And it brings a good return. But to me, if you're properly promoting your opportunity and you maintain that rapport and level of trust, I don't see why money would dry up.
Yeah. What do you mean by a solid deal? I mean, I know it depends on the person, like each person's perspective, but how do you know if you have a solid deal to present? Like, does that mean there's more equity when you refinance at the end so that you can pass it out? Or
I like this question because there's no right answer. My answer to your question is, how confident are you in being able to perform? And so for me, it's back to what's the worst case? What's the best case? And if I promote both as an opportunity for the lender to work with me and they're okay with it, I've created that level of trust and essentially a great deal. It doesn't matter if I'm leaving money in. It doesn't matter if I'm pulling out all my money and some. It's how that you're emitting confidence, right? They're buying into you. The product is the property, but they're also trusting that you're going to perform, right? So am I informing them well? Am I understanding my numbers in the market? Am I doing my homework? Am I properly analyzing what if they ask me the question, what happens if the market tanks? And I can provide a valid solution, I believe I've convinced them and earned their trust to take that partnership on, right? So it goes back to questioning your why. If your why is strong enough, nobody will be able to talk you out of it, including a lender. You will be able to combat every question and concern that they may have. And if you give solid, valid points, it doesn't matter if you're leaving in money, because that's not their concern. Their concern is, will you perform? Will you pay out? That's not their problem if you leave in money, right? Their problem is, will you not, if you don't pay, what do I have to do to get my money back? And if you have no escapes and you're only going off of one plan, me, if I was a lender to you, I'd be extremely concerned. Now, if you come to the table and you got multiple exit strategies because you've done your homework, you've run worst case, you've run best case, you've run everything in between, and you answered every question that I had with confidence, I would be more inclined to offering this partnership, right? So it goes back to doing your homework, preparing. Preparation is going to be key to success. Are you preparing properly? Are you running your numbers properly? Can you answer the hard questions? Because I don't believe there's any stupid question. I want to be able to answer all my lenders' questions to the T with confidence. And if I can't, then I really may not have all the information I need to lock down the deal.
Okay, yeah, that makes sense. Thank you.
Yeah.
Actually, I have a question, CJ.
Yeah.
So, with this market, with still prices are going up and we don't know what's going to happen, are you implementing any different strategies when you're purchasing, like seller financing or subject to, or other ways of purchasing?
Absolutely. It's all about knowing how to make the deal work. So the information side, the knowledge gathering side, constantly learning and understanding different angles to attack a deal, right, is key. But then again, going back to knowing that it works, you have to implement it and try. And I know right now it's probably not my strong suit to do that type of sub to or seller financing of some sort, just because there aren't motivated sellers in that sense. You can throw a property you're probably belly up on market and get more than what your mortgage payment is and some, even though it's probably not worth that right now. You know what I mean? So how I'm attacking or adjusting my numbers is I'm pivoting on the acquisition side by being ultra selective and or just patient. If that really makes sense. Like, I'm running my numbers a little bit more conservative than I'm typically do, just because of the unknowns of 2021. So if I was running numbers with this type of 10% unknowns, right now I might be at 15, because I want to make sure I can sustain. Like, back to what I was sharing, right? COVID is well over 8-9 months now since the lockdown. 6 months is a pretty standard amount of rainy day fund. Well, we're 3 months past that and probably going another 3 before we're maybe in the clear. Well, now I need to adjust my numbers with that in mind, because that's tangible. That's results that I just experienced. That's reality. That's 2020. If I can carry that over to 2021 and things get better, then no harm, no foul. I just have a big reserve of emergencies versus I bought too high. I'm underwater. The market shifted. I wasn't prepared. And our strategy, buy and hold, money is never lost until you sell. It's just working. So even if the market tanks and I bought a $100,000 house, it's not worth 50. If I'm cash flowing, yeah, it sucks that I got all that money tied in the deal, but I know eventually in time it will come back. It's just a matter of being patient, right? Running those scenarios in your deal acquisitions might be key for you to understand that, hey, if I do throw in 100 and it does shift and I lose 50% value, can I be okay with the 50K left in? And it depends. It depends on your situation, your strategy, your why, your what.
Thank you.
Yeah. Any other questions?
Hey, good evening, CJ. I'm currently investing in real estate right now. I have a duplex out in Norfolk. Just purchased this home, which I plan to turn to a rental eventually. But I was interested. I was talking to Young Jay about long distance investing, and right now one of the issues I'm having with my property in Norfolk is that I was property managing myself for 2 years, and then this last year, all of a sudden, I'm thinking that the property management teams, I did my research too, looked at ratings, looked at their sites, just all sorts of stuff. And now I'm having issues with them. How do you select your property management when you are distance investing?
Good question. One of the consistent questions we get, being that we're out of state, it's hard because you can do your due diligence and your homework, but at the end of the day, you're going to have to trust somebody and take action, right? And give them a shot. And what I found to work in our favor is to be intentional with the relationship, if that makes sense. So I'm active with my team. I'm not waiting for a response that, hey, your tenant's leaving. By the way, you got to do $5,000 worth of work. It's no, 1 month, I didn't hear back from you. I just want to know a status update. How are my properties performing? Am I having any issues? Should I be planning for an eviction? Should I be planning for a turnover? Be proactive in it and establish that communication and expectation on their part that they should be sharing with you anything that may arise that may be of concern in plans and preparation for you to then execute a good strategy versus being the quote unquote victim, right? Oh, I didn't know. You're evicting. You didn't tell me. Nah, to me, it's all about what am I doing to put myself in success? Because I trust them to an extent, but ultimately I got to own the results, right? So communicate with them like crazy, especially in the beginning, and hold them accountable. So part of what I do is I interview people and I take detailed notes. And if I make claims and they agree to it, I hold them accountable. It's very hard conversation to have, especially being out of state where you're not face to face, because they probably put you on mute, start swearing at you or whatnot, but put you back on and be like, oh yeah, okay, sir, yeah, we'll take care of it. I don't care what they do as long as they honor their word. Because the moment you break your word, you've lost your trust. And if you lose your trust, I don't think I should be paying for a service that I can't get 110% out of, right? Because I act and partake in consistent abundance relationships. I want to grow with you, but you also got to prove to me you're worth growing with. It's a two-way street. You know, without my property, you don't have a job. Without you, I don't have a property manager. Let's make this relationship work. Ebb and flow, yin and yang, right? But it may require a lot more action from you up front to get on them about things that are an issue for you. Because then my next question would be, have you brought up the concerns that you might be experiencing now prior? And if not, maybe it's just a simple communication issue.
Believe me, she's tired of hearing from me. Like, I'm on my stuff. Don't worry. But yeah, well, things aren't working out. I'm just gonna have to reevaluate, do more interviews, and move on.
Absolutely.
Trying to get that team to trust.
We're a firm believer in having three. So you always have your go-to, then you have two backups because anything can happen, even if you like them. We had one where our property manager just retired out of the blue, medical reasons. And to go from, oh, we have 40 properties with you to, who's next? We didn't, he was great. Why would we even try to even replace him? He was amazing, but retirement happened due to medical. I didn't foresee that, which then gave me the lesson that having multiples, having backups, hey, you don't perform, I'm off to the next, might be something you want to do.
Absolutely. I'm flying out tomorrow to go check on the property, interview more property managers anyway.
Nice.
I do have 2 more questions for you, if that's
Sure.
all right. One of the greatest benefits we have is, investing in real estate is the tax write-offs, and you assuming primarily as the main source of income, how much do you determine, or how much do you know to write off to set yourself up to show enough income for future investments? Sorry, my wife.
You're good. That's a good question because I'm not mortgageable.
Oh.
I choose not to show income because it requires me to pay taxes, right?
Absolutely. Yeah.
So my tax advisor specifically prepared and planned a strategy where I just got to get good at raising money. I'm just really good at raising money. So if I can raise money, I can acquire whatever deal I want. And like I mentioned in the beginning, we're in commercial now. Commercial takes very little account to your personal financial situation. They assess the asset primarily under a certain dollar amount. If wasn't Jazz, it's like $1 million, right? If you're under $1 million, they do take some sort of personal guarantee or maybe your hard asset like your home or whatnot. You might have to leverage that, but they primarily run the finances off of the product or the property. Don't need me, right? So I somewhat pivoted and shifted gears to a little different strategy in that sense because I'm not mortgageable, or I implement some crazy, unique strategy that, I mean, you can find a way to make a deal work no matter what, but it challenges you to get good at raising money. That's what happens.
Absolutely. That's a perfect segue into my next question, actually. You know, with COVID-19, I know the private housing market has been skyrocketing because of the lower interest rates and everything. I'm just curious, because of businesses taking this harder hit due to COVID, have you witnessed a drop in prices in the commercial real estate, or is it doing the same thing, just skyrocketing alongside private housing?
That's a great question. And what we're analyzing now, and I mean, mind you, we're learning a lot because we want to get bigger and better in commercial. So I don't know a lot, but I know enough. And what enough I know of right now is, yes, they're taking hits in certain demographics of commercials. So like the retail space, the food industry, you know, hotels and multifamilies, possibly depending on what's going on. Those things are taking hits. But the beauty of what commercial has, in my opinion, is the way to analyze the deal and what it's worth. You're no longer playing market value. They're not assessing this commercial building with the last commercial building that was sold. They're assessing your building off of the performance. So if building A has a 15-year lease with a solid tenant like a McDonald's, this is a solid performing asset. It's worth a ton of money. Well, if the identical building next door, same square footage, size, look, everything, is rented out to, let's just say, a nail salon or somebody that's not essential in COVID, who can't work due to regulations, restrictions, or non-essential stuff, or even like a bar, right? Bars are taking hits. If that's what's next to it, identical everything, this is worth nothing almost because it's not producing anything. So for me, I like commercial because it's quickly, you can analyze deals a lot more logical. It's all mathematical, right? There's very little, well, I got to worry about the market appreciating this and that. In my experience, it's all about, can I get this product to perform with a certain level of tenant in play? Because now that makes this $100,000 property worth $500,000 or $1 million just by simply restructuring, re-inputting a new tenant. Sometimes it's not even rehab based, it's just lease based. That's kind of why commercials piqued our attention. Housing market does this way too much for me, and the return can be so much greater in commercial, but you got to learn, right? And a lot of the learning is scary because you don't know what you don't know, and in order to know, you got to do. But doing is fun.
Awesome.
I'm sorry, I went off on a tangent, so I want to make sure I answered your question.
You answered it, but then you went even deeper, so I appreciate that. Thank you.
Okay, yeah. Commercial is awesome if you can get into it. Any other questions? Okay, Brandon, I think we're at the hour mark.
Yes. All right, right on. Awesome discussion. And I just want to thank you again, CJ, for just sharing your insight and valuable information and answering all of our questions. And just to the group, thank you folks for spending your time with us here. And we just want to honor your time and if you don't already know, my name is Brandon Rabe, and I'm just going to close out our meetup tonight. But before I do, I want to highlight a few things. The meetup does have a new email address. So we're going to put that in the chat for you to add to your contact list. If you're already on the list, you don't have to do anything. Just look out for the new email address and make sure it doesn't go into your spam folder. The email that we're going to send out is strictly for the meetup. We're not going to spam you or anything, and we're not going to share it with any third parties. So we just want to let you know about that. And also, if you wanted to be added to the WNN Properties email list, to get in contact with Jasmine. Her email is jasmine@wnnproperties.com, and she can keep you updated with the WNN specific properties and events that, not the properties, but the events that they're going to have and any updates that they have. The other thing is also to join our Facebook group and to like our page. So, and to make sure that we have your updated email. As we plan for next year, 2021, we just want to make sure that you get all the updated information because there might be a lot of changes going on as far as meetup times or platforms, things like that, especially what the government says on how we can and cannot meet. So email is probably the best way for us to get in touch with you, and the Facebook group. Also on the group, we're going to be holding some polls just to get your folks' feedback. So if you could kind of respond to those, that'll help us to plan out next year and all that. So lastly, there is no meetup next month in December. We just want to allow everybody to have time to just enjoy the holidays. But right back in January, we're going to be coming back again. So yeah, we're just excited to what next year's going to bring. And with that, on behalf of the Westside Meetup, I just wanted to wish you guys, or we just wanted to wish you guys, just a happy holiday, safe holidays, and a prosperous new year. So we will be ending the recording now, and please stick around for networking and just to talk story. Thank you.